Good morning. I hope you're all very well. It was a tough February, not so tough for the markets, but certainly tough for South Africans. A lot of bad news. I'm sure many of you, if you hadn't already, have started packing your bags and ready to leave. Or if not packing your bags, you've been packing your investment bags and trying to take as much money offshore as possible. Fortunately, from an investment perspective, we are reasonably hedged, and I'll be taking you through the details of that early on this morning. But first, let's look at markets. As I said, February wasn't too bad a month from a market perspective. The market spent some time digesting the fantastic returns in January. January certainly was once in a decade type positive returns for all markets. But February was a bit more of a mixed bag. Things not quite all positive, but mostly positive. South African equities were down, pulled back by resources. China also pulled back after phenomenal January. Emerging markets also pulled back a little bit after phenomenal January. But generally, things were quite good. And that's because things on the ground have improved. Europe avoided a recession in Q4, which is great. So things aren't as bad as we feared in Europe. Secondly, China reopened, and the Li Qiang index, which tracks real-time data, that's electricity consumption and rail freight, suggested that China grew 6% in December. So that's fantastic growth from the reopening. And then third, the dollar continues to be weak. It's 11% weaker from its peak, and that's helped reduce the credit squeeze on emerging markets and the rest of the world in general, ex-US. So on the ground, things are looking better. As a result, markets have recovered. There was a little bit of a rebalancing in February as people digested, and some of the very strong numbers got normalized, but generally things are looking better. Of course, risks always remain. And the biggest one is the US, and particularly inflation in the US, which is not falling as quickly as the market had assumed. I'll be talking more about that. That's probably one of our biggest risks. In fact, it's not even a risk, it's a base case scenario for us going forward. A higher for longer inflation, higher for longer interest rates, but no panic from a Fed perspective. We don't think the Fed's going to push rates up hugely, just slowly and for longer. The second risk is the Russia-Ukraine war escalates and spills into another energy crisis. This is not our base case. And I'm not even going to talk about that today because it's not part of our base case. And the third risk is US-China geopolitics escalating, which is, again, not part of our base case, but I will talk about it just because I'm talking about China and the reopening and how things are looking there. But overall, from a global perspective, from a market perspective, things looking okay for 2023. Certainly better than 2022. Not that that's saying much. But let's look at South Africa. I'm sure you're all very, very frustrated. What's the bad news that has been coming out? Everyone's listened to Andre de Ruyter's interview, read the reports, read the allegations, and it is truly shocking some of the news that is coming out. Yes, all allegations, not quite sure what is true and what's not. Allegations of cartels that reach all the way up into the high levels of the NEC. And if it's true, it is truly shocking. But we don't know exactly what is going on. It has been a lot of bad news. And on top of that, we had the grey listing by the FATF. And that, again, is poor for the South African outlook. We're looking at reduced investor confidence. We're looking at reduced South African growth. And combined with load shedding, it's just more headwinds on the horizon. So I'm not surprised that people have been requesting to take their money offshore, to say it doesn't matter the rand is so weak, let's take all our money offshore. We just can't take the risk of being in South Africa the way things are melting right now. But I want to point out three things. In general, all I'm going to say is things aren't as bad as they seem, and please don't panic. And there are three reasons why I think things aren't as bad as they seem. The first is every state of disaster that comes around leads to an opportunity. And that was true for COVID with the healthcare sector, it was true for the Russia-Ukraine war and the energy sector, and it's true now for the electricity state of disaster. And when I mean that there's an opportunity, I'm not just talking about an opportunity for corruption to take hold, but an opportunity for South Africans to do what they do best and be entrepreneurial and take growth forward. And if you think about it, what was different about Eskom? What is different about load shedding to everything else that we've been through? I mean, most South Africans use private hospitals. Most South Africans watch DSTV or ETV, not the state broadcaster. Most South Africans have some sort of alarm system or private security they don't rely solely on the police. Most South Africans use a schooling system that is at least partially subsidized by the public and not the government. And most South Africans don't, well, when SAA went under, there were still other airlines that could be used. When the postal service goes on strike, there's Postnet. When Transnet's not working, people use road. So what is different about the load shedding disaster right now is that because of the monopoly on SA electricity production, there was no alternative. If you look at everything else I've mentioned, there was always a private sector alternative. South Africans could just keep on going, someone would rise to the occasion and create an alternative, and people would use it, and life would carry on. But because the government had a stranglehold on our economy, because they refused to allow competition into the electricity sector, we are sitting where we're sitting. Despite 14 years of this, that monopoly was in place. But now, finally, we're seeing, in the last 6 months, we're seeing a partial, not complete, but a partial deregulation of our electricity sector. And that is an incredibly good news item, because it means that the South African entrepreneurs can do what we've done through every other sector, and we can start providing alternatives. And that's looking fully in place. According to Investec, the South African mining sector has a pipeline of embedded generation projects with 10 gigawatts. Now we're load shedding currently 5 gigawatts. So that's double the amount that's being load shed. That excludes the property sector that are going rooftop solar, residential sector, the big industrial producers of electricity are also going to have self-generation. It excludes the Western Cape, who are looking to put in 6 gigawatts of power. So the point is, don't hold your breath on Eskom. I'm not saying that you should. I think the outlook there is murky at best. We've got the big reshuffle tonight at 7 o'clock, and we'll the cabinet reshuffle, and we'll find out who the electricity Minister of Electricity is going to be. But still, I think that we can rely on entrepreneurial South Africans, hardworking South Africans, to do what they've done in every other sector and produce enough alternative power supply over the next 2 years to fix the problem. So that's point one, is that I think things can be fixed despite Eskom. Point two is this slide. Now, the JSE, just like every other sector that I've mentioned, whether it's education or security or schooling or airlines or postal, the JSE has faced low growth in South Africa for a variety of reasons. And the big companies that are listed in South Africa have searched for growth outside of South Africa because there was no growth in South Africa. And as a result, you have this phenomenal diversification that doesn't exist in other small open economies. So this table shows the percentage of revenue on the JSE that is not from South Africa. So if you look at the SWIX, which is the biggest, the shareholder weights index, 55% of revenue is from outside South Africa. If you look at the all share index, 65% is from outside South Africa. And if you look at Aussie 40, 70% is outside South Africa. So even with South Africa slowing, even with South Africa hitting the headwinds we are facing because of load shedding, we are already quite diversified by investing on the JSE. The first column on the left that's the Sygnia blend of active managers, and that has 60% with foreign-based revenue. So that's a fantastic diversification source already. So even with things slowing down, it's nothing new to South African companies. South African companies have faced headwinds, and they will find ways around those headwinds, and they will continue to grow and continue to provide returns to shareholders and services to clients and jobs to people. And the private sector will continue to carry on going. So that's the first point is that despite Eskom, South African private sector will find ways to provide alternative power. Two, the JSE is already quite diversified. And three, brings us to this quite important, although complex looking table that RMB have put together. And the point of this slide is that if you're not planning to immigrate, if you haven't already packed your bags and bought your tickets and sold your house, well, if you're going to retire in rands, then you need to understand that the rand can be very volatile. And not only that, the rand has spent periods of times up to 3 years or 30% where it has strengthened in the past. And again, despite South Africa, whether it's because resource prices are running or because the dollar is weakening, and I've got a great chart that at the end, the rand can strengthen for long periods of time. And you don't want to reach a retirement age and suddenly see 30% of your retirement disappear because of rand strength. And this table looks at what the optimal hedge is, the currency hedge. So if you were to look at the bottom right-hand corner, so you had 100% of your money in equities, that's the top row, your horizontal row is the percentage in equities, 0% of equities on the left, 100% of equities on the right, and then the bottom row shows how much, the going down shows how much you should have offshore. So you go right to the right, you want 100% of your money in equities, and you go all the way down, you want 100% of your money offshore equities. That's fantastic, perfectly doable. If you do that though, if you take all your money offshore and you put it into the MSCI World Index or the 4IR fund, or whatever your favorite is, the skeleton international equity fund of funds, then you should hedge half of the currency exposure that you've taken out to ensure optimal low volatility rand returns. On the other hand, if you are like the skeleton balance 70 fund, which is my favorite child, and you can see that we've got 70% equities, so you go across to 70, we've got 35% offshore, you go down to 35, it says you should hedge 8% of your offshore. So you shouldn't actually set at 35, but you hedge that down to 27%. And that's what we've done. So I think it's important to understand that if you are saving in rands, and if you need to use that money to spend it in rands, then you need to worry about rand strength. It may sound very, very strange thing to worry about, but the rand does strengthen over time, despite what South Africa does, and we need to prepare for that. So the first and simplest way to do it is you just invest in the South African equity indices. If you invest in the Aussie 40, 70% is offshore. That's rate diversification. Although SWIX, 55% is offshore. Or you take your own money offshore, but then you need to find a way of hedging the currency, which can be quite difficult in terms of opening accounts and margining. Or you invest in one of the Sygnia balance funds, the Skeleton Balance 70 Fund, where you have the optimal blend of South African equities, global equities, and hedged global equity. And the three of those means that you've got a great diversification, but also the proper protection against rand strength. And you can get very cheap protection for rand strength because it doesn't happen all the time, but it does happen, and it's an event that needs to be protected against. So I think we're sitting at 35% offshore for our funds, we're not at 45. We may get to 45, but if we do, again, you go down to 45 on the left-hand side, you go across to 70. And you can see there, if you're sitting 45, well, you should hedge 28% of the portfolio, and that's probably what we will be doing, or close to that, when we get to that offshore allocation. Right now, we still think there is some value in South African equities, and we are cognizant that a good 60% of our South African equities already have exposure to offshore earnings, which gives us a great deal of comfort. Okay, so that's a partial response to some of the bad news that came out in South Africa this month, the grey listing, load shedding. I will be talking more about it when I get to South African sector. That's still happening. But let's get back on track to the usual slides, starting off with the outlook for our global worldview. And the good news is that the Great Rebalancing is still underway. Now, we had a huge amount of inflation that happened in the last 18 months. And a part of that was the Russia-Ukraine war, but a large part of it was COVID. And that was driven because we had two things that happened at the same time, which shouldn't have happened. And both driven by COVID. COVID led to people being furloughed, but still being paid. So they were sitting at home earning money with nothing to do. So they spent money on goods. They bought more cars and TVs and things. At the same time, we had lockdowns. The same people weren't working, and so we couldn't produce anything. And so there was a shortage of supply of goods and an increased demand of goods, and that led to huge amounts of goods inflation. But what's happening now is that's rebalancing. You can see here the chart on the top there, the global manufacturing PMIs for the Euro area, for US, Japan, and United Kingdom, all still in contraction. Great news. Growth is slowing. Goods inflation is coming off quite quickly. The bottom panel shows that services PMI, people going to restaurants, people traveling, people spending money on things they couldn't during COVID, that is accelerating very nice. So services PMI is going up, which is protecting growth. Manufacturing PMI is falling, which is helping inflation come off. And that great rebalance may not be happening fast enough. I mean, I do think inflation is here to stay for a while, but at least it's happening. And that is what's allowed things to not fall into recession this year. And that's why our base case has never been for a recession this year. Or certainly not until maybe the fourth quarter for the US, but globally, certainly not no recession. And the other great rebalancing that's happening is a rebalance between the US and the rest of the world. So we had a period of US exceptionalism last year. It was why the dollar was so strong. They had a lot of perfect storm tailwinds. They had much higher mobility. They didn't lock their population down as much as the rest of the world for COVID. They were insulated from the energy crisis in Europe to some extent, and they had huge amounts of stimulus spending. I mean, vast checks that were just printed and paid to everybody. But all of those are reversing now in 2023, which means US growth is slowing, while the rest of the world growth, Europe, China, Japan, even South Africa to some extent, is recovering. And that is keeping the dollar weak and is also helping rebalance the global growth and global inflation. So as long as this great rebalancing stays in place, we think that the outlook, while tepid, is not for a big recession and another 15% pullback this year. So let's focus on the US quickly, because that is the big risk. Risk is that the US will panic. The US will raise rates 2% or 3% from here to let's say 7% and squash the US growth, but also because they panic and they push US rates up so quickly, the dollar will strengthen and that'll destroy growth in the rest of the world. So certainly a risk, but not our base case. Our base case is that the Fed accepts higher inflation but continues to raise rates, but in a moderate fashion of 25 basis points per session. And we've got some news that supports that. We've got the Fed coming out. You can see here Powell saying that the disinflationary process has begun, which is good. He also warned that persistently high inflation could stay elevated in 2023. We agree with that, but he's acknowledging that the disinflation period has begun, i.e. he's not going to panic. We saw inflation continue to fall in the US, but didn't fall as much as expected, to 6.4 instead of 6.2. But again, the Fed came to say, listen, no, we're not focusing on core inflation, we're focusing on core or super core inflation, which is excluding energy, excluding food, and now excluding shelter because of the lag effects. And that did seem to be rolling over quite nicely. So again, it talks to the fact that the Fed's looking through some of the inflation. So they will accept high inflation, but they will still carry on pushing rates up slowly. And that is good. The chart on the right just shows historically how the US market has performed during recessions, which is the pink line. Which you can see is roughly flat from where we are right now. The dark blue line, which is up quite nicely, about 15% over the next 2 years from where we are now, and then the green line, which shows where we are roughly between those two. And I think that's pretty fair. I think the US is roughly fairly priced at these levels. I think we will stick closer to the no recession line, but I do think a recession in the US is likely at the end of this year or early next year, eventually, as all that pent up demand and pent up savings get used up while rates are still quite high. But for now, I think that it's looking relatively fair in terms of the pricing. But volatility is going to stay high, and it's really all about inflation. So we've had some really strong US numbers come out. Retail sales were very robust. Inflation remained sticky, and the dollar strengthened, and markets came off. But then we had very weak US housing numbers. In fact, US house prices fell by the biggest sixth monthly number since 2008. And US consumer confidence plunged to 102 from 108, or from 108 expected, and the dollar weakened. So there's going to be a lot of volatility as all the numbers come out. Good numbers is going to be bad for markets. Bad numbers is going to be good for markets, and we're going to be stuck in this range. Overall, we do think the US is going to see more headwinds as it rolls out of this period of exceptionalism. And it's still priced quite strongly at 18 times earnings. Meanwhile, Europe and Japan are 12 to 13 times earnings. The UK is 11 times. And those economies certainly have headwinds. Don't get me wrong, but a lot of them are priced in, and a lot of them, we're starting to recover from, whereas the US is still seeing a little bit of headwinds. So headwinds growing in the US, headwinds or tailwinds growing in other economies. And I think that there's room for that differential in earnings to narrow a little bit further going forward. And so we remain underweight the US. Okay, the second biggest risk I mentioned was the Russia-Ukraine war escalating, and I'm not going to focus on that today. The third one is geopolitics in the US, and it certainly looked like it escalated in February with the balloon incidents. And we had at one point, we had the US spend $400,000 on a Sidewinder air-to-air missile to take out a $12 hobby club balloon over Canada. I mean, if that isn't getting a little bit too excited, I'm not sure what is. At the same time, there was another balloon that was over Montana, and China claimed that it was just merely a civilian airship, and it had nothing to do with spying on the US. But certainly, things will remain tense between China and the US. There's definitely an economic war going on in the chip market, an economic war going on in the EV market. I mean, certainly China remains the largest supplier in EV batteries and solar panels, and that's something the US is concerned about. And the US obviously still trying to control the chip market, although signs are already that China is getting around that. China pledged $1.9 billion towards its top chip manufacturer this month. I mean, compared to the US, which invested $200 million into their chip industry to try and accelerate that growth, China pledged 10 times that. So certainly China taking this very seriously, and they have the ability to do that if they want to. But coming down to things on the ground, China opening up nicely. Yes, China's got a lot of headwinds in the long term. We remain very concerned about China in the long term, maybe even medium term. But in the short term, there's a huge amount of pent-up demand. There's a huge amount of consumer savings that are there. Property sector seems to be turning itself around. If you look at the charts on the right, you can see that property prices are bottoming. Not going to be a huge driver of growth, but it's not going to be a drag on growth in 2023. Meanwhile, we've got consumer demand expected to add 4 to 4.5% growth. You've got all the credit data accelerating. You've got money supply data accelerating. And you've got China's manufacturing PMI rebounding to the highest level in a decade, 52.6. Oh, fantastic. So China's services PMI up to 56.3. And so China growth really taking off nicely. Meanwhile, inflation is still low, and they can continue to support the economy. So they really are finally starting to diverge, not only in support, but also in growth. And we think that the Chinese stock market it needs to reflect that further. And as a result, emerging markets also need to reflect it further. And we still remain overweight those two sectors in the short to medium term. So we had the State of the Nation in February. We had our grey listing in February. We had our budget in February. So we start with the budget. We had Enoch Godongwana talking about the difficult domestic and global economic environment. I must say, I do miss Tito, and this little plant that you bring to the budget speeches certainly added a little bit of color. But it was a decent budget. I mean, considering all things, it was a decent budget. Once again, there was an additional nearly 100 billion rand in revenue as a result of the resource strength and commodity strength and additional taxes that was earned on that. So that was great, but it was well spent. Some of it was used to pay down debt. Some of it was allocated towards fixing SOEs, and some of it went to social grants, but it was generally well spent. Unfortunately, the debt to GDP numbers have been pushed out. And now, as you can see on the chart on the right, instead of consolidating this year, they're only going to consolidate in 2025 to 2026, and at a high level, 73.6%. And that's because the government has taken on 254 billion rands of the Eskom debt. And that had to happen. I mean, Eskom was going under without that support. There's still no plans on how Eskom is going to be fixed. So we'll wait and see who the new Minister of Electricity is tonight, and see if there are any upside. Fortunately, there was some good news. and that came in at this budget, and that came in the form of load shedding relief. And I really do believe that this is important. I think the private sector, again, partial deregulation, tax incentives at the consumer level, tax incentives at the business level, and removal of the fuel levy at food producers. That's all going to work well for South Africa. It's all going to accelerate investments into renewables over the next 2 years and help reduce the demand from the Eskom's grid. And I think that I think 2023 is going to be a tough year, but towards 2024, hopefully by then, Kuberg's back online. As part of Medupi and Kusile could be back online, and we're going to have a lot more supply online from the private sector. And solar and wind are very easy to put together. And they basically come as assembled packs, and you have to put it together with a few nuts and bolts and screws and some cement, and it's there. So it shouldn't take too long. So we'll see. Again, that's not too much detail, but I think that the tax relief is good. The state of the nation wasn't great as well. Again, lots of promises, but there was no addressing of any of the broken promises that happened in 2022. Last year, SONA promised unbundling of Eskom by the end of 2022, which didn't happen. Last year, SONA promised that there would be public partnerships to repair Transnet's facilities, and that didn't happen. So still a lot of promises, right things being said last year and this year, but lack of detail. Then also announced at SONA was that Eskom now reports across 4 ministries because of the state of the additional Eskom minister, plus the fact that there's a state of disaster means that it was also reporting to the governance and traditional affairs minister. So things are just getting more and more complex at Eskom. So again, not holding my breath for Eskom, but I think that's enough partial deregulation for South Africans and to get that fixed. And finally, we had the grey listing, which is tragic, but I don't think it's has a huge impact, or didn't have a huge impact on markets. Yes, the rand did weaken on that Friday, but I think a lot of that rand weakness was dollar strength. It was driven by some bad inflation numbers. The core PCE that came out in the US was weaker than expected, higher than expected. And I think that was the main driver of the weaker rand, not so much the grey listing, which has been very well telegraphed. There was an 18 to 90% probability of it happening, nearly 100% by January, and I think the markets had priced it in. Yes, this is very bad for investor confidence, and it's going to lead to probably less money flowing into South Africa. This also means it's more difficult for South Africans to interact offshore, to invest offshore, and it'll certainly lead to more red tape, which is going to slow things down. But besides slowing things down and reducing confidence, it doesn't have its impact is relatively muted relative to load shedding. I mean, load shedding was estimated to cost South Africa last year 300 billion rand, 5% of GDP. The grey listing may cost South Africa 1% of GDP over the next year or 2 years, and hopefully by then we can get out of it. So I think a limited impact compared to load shedding, I do think that while 2023 is going to be a tough year, we'll push through, and 2024 should be a better year with more supply coming in line, and hopefully in the next 18 months we can get off the grey list, and we'll have to watch and see. But for now, we stay underweight South African equities, and we stay overweight global equities, as we have for quite some time. This is a great chart. While we're underweight South African equities, we do think there are great places to be in South Africa. South African bonds, we are overweight. I've said many times, got amongst the highest real yields in the world, really phenomenal, 10.5% yields. But if you are a little bit more conservative and you don't want the volatility of bonds, then the Sygnia Enhanced Income Unit Trust is looking fantastic right now, because interest rates have been pushed up so high, and we are expecting another possibly 25 basis points to come, and you're sitting at about a 9.5% yield, nearly 10% yield on our enhanced income fund. So that's a almost 10% return over the next year, with very little exposure to bond markets, and almost no exposure to property markets. So it's a very stable return. This chart shows your volatility on the horizontal axis, risk, and return. This is looking back. So this is looking back. So you can see the historical return, because interest rates were so low, around 7%, and risk around volatility of about 1%. But as you can see, the green dot is the Sygnia fund compared to all the other gray dots, a very decent return compared to very low risk. Very conservative fund. And now with interest rates being pushed up, over the next year, you're going to get close to a 10% return based on current yields and very little volatility. So for those who are more conservative than bonds, getting a 10% return with very little risk, it sounds like a decent place to be. So we certainly are also overweight this sector in our funds, and we think it's a good place to hide if you are concerned about the volatility. That said, we do think the rand is going to strengthen from these levels. We think that too much risk has been priced in. So summarizing, bring it to a conclusion, our overall positioning, as I've said, we are overweight global equities, and that is particularly non-US. So that's emerging markets, a little bit of Europe, and a little bit of Japan and China. And a lot of that's to do with the weak dollar. So the chart on the right shows, this is from BCA, shows how the PPP or purchasing parity does work in the long term. In the short term, not so much, but this shows that over the next decade, you can expect the dollar to weaken by 19%. So that certainly means that, yes, in the short term, the dollar is going to whipsaw between. It will strengthen on strong US data. It will weaken on weak US data. But I think over the long term, when we push through this, the dollar has got a lot of headwinds, and it is very expensive, and it will certainly follow PPP and weaken, which means staying underweight the US. We also stay overweight the African bond because of the yield, and we do have protection against rand strength. So yes, we are overweight global equities, but we have got protection. You can get some very, very cheap optionality, which we put on in case the rand does strengthen. So that's how we're playing that. Best of both worlds, take your money offshore, but hedge the currency, and you win-win. Overall, our view stays the same. We do think inflation is going to stay higher, interest rates are going to stay higher, volatility is going to stay higher, and as a result, we overweight value in the US, and we overweight global healthcare, and we do have protection in place on the equity market in case we do have some pullbacks into the middle of this year. Generally, if you look at the calendar years, we've still got March, April, and generally quite strong months, but May to November are weaker, and we do think that having had a very strong Jan and a decent Feb, and we'll hopefully have a decent March as well, that things could weaken into the mid part of the year, which is why we do have some protection in place. Then in terms of our global equities, no changes here. We are overweight all four pillars. We're overweight decarbonization with our sustainable economy ETF. That's doing beautifully. It has returned well ahead of the fourth industrial revolution fund, even though there is some overlap there. We've got deglobalization, where we're exposed to the next billion consumers, and that's emerging market Asia, and that we do through our EM ETF or our China unit trust and ETF. Slowing growth because of high debts, and it's our fourth IR exposure, and that's still struggling a bit, but we retain exposure to that. Demographics and slow aging populations, that means you need to have exposure to healthcare, and we overweight that sector as well. So we're keeping exposure to our four themes globally, and that should provide us with exposure to decent growth despite a low growth environment over the next decade. Okay, that's me. Nice and short today. It's time for some Q&A. Let's see what we've got here. Okay, Alex says he has got some money that he wants to invest for the long term, but he wants to hedge against the rand, the weak rand. What do I do? So, Alex, that is quite difficult. I have mentioned that. You need to set up. The only way to hedge the rand is to set up a futures account, and you need to get involved with hedging the rand through derivatives, and that gets quite complicated. So I think the easiest thing to do is to invest in one of our balanced funds, where we do that for you. So the Skeleton Balance 70 fund, as I said, we have got our offshore allocation. We're actually obviously taking more offshore. We're extending the amount of equities we have offshore right now, but we're also extending the hedge so that when the rand does strengthen, we are protected against rand strength. And that, again, looking pretty attractive, that risk return from the optionality in that position. Anonymous says he's noticed the Sygnia Divi fund is down over 8%. Is this poor performance because of the drop in the price of commodities in the mining sector? Are these companies big dividend payers? Is there hope going forward? You're spot on. Yes, the Divi fund does have a decent allocation to the resource sector, and the resource sector was hurt very hard in February. It was driven primarily by platinums. The platinum stocks were down 15-16% in February, and that they're very high dividend payers right now. In fact, all commodity resource companies in South Africa are very cash flush. They're not spending money, they're not investing money. They are earning windfall earnings, and they're sitting with a lot of cash. As a result, they are paying very strong dividends, and that's of course the pullback in Divi fund. Resource companies should rebound from these levels. I'm not incredibly bullish on resources. I do think that the way China is going to grow over the next couple of years is going to be from domestic consumers. Not so much a massive boom in the construction industry. That said, the construction industry is at least recovering, and it's not shrinking anymore. So that should keep commodity prices relatively stable. And so, I do think that commodity prices are not going to collapse to the lows that we've seen in the past. And as a result, the Divi fund should recover with resource prices. Alan, SA bonds or the Life Income Maximizer Plus, still a good bet for the communities? Yes. The Income Maximizer Plus fund on our life license is a fantastic fund. We are overweight. It's got a nice blend between bonds and some credit. And we've actually introduced a new vehicle into that, which invests in shorter term bank instruments, which are currently yielding over 11%. So that's looking very attractive. I do think that's, if you can invest through the Sygnia platform and you can invest into our living annuities, I think that Income Maximizer Plus is a fantastic product. It's well blended between bonds and credit and the new short-term NCD instruments, all of which are giving you a better yield than bonds at low volatility. So I think that's a great place to be, and I certainly think that it's a great product. Alex asked a different question. How would Sygnia act, i.e. change investment strategy when the US recession eventually hits, as expected at the end of 2023? Alex, it's a good question. So as I said, we have already put protection in place in terms of our overall equity exposure. We do think that US equities could, so we can, into the middle of this year, as the market anticipates the slowdown in the US towards the end of the year. However, I don't think it's going to be a huge pullback, because it will be a mild recession. And more importantly, we do think that the rest of the world is more unlike the 2000s, when the US drove the rest of the world. And before that, over the last decade, the rest of the world, particularly Japan and Europe and South Africa and other emerging markets, are far more linked to China than they are the US. So despite the US slowing down this year, China is going to continue to grow. They've just come out with an expected growth of their target growth for 2023 of 5%. I think it's going to be a bit higher than that, maybe 5.25%, maybe 5.5%. So China will continue to recover this year, and that will cushion against a slowing US, but it will particularly cushion Europe, it'll cushion emerging markets, and it'll cushion Japan. So how are we positioned? We've got protection against markets falling in the middle of the year, and we are positioned by being underweight the US and overweight the rest of the year. But yes, I think there are risks that in the middle of this year, the US market could fall a bit in anticipation of the slowdown at the end of the year. But it all depends on what inflation does and what interest rates do and how the Fed handles it. And there could be a Goldilocks scenario, but I think that's a very low probability. Luke asks, what are the risks of hyperinflation in South Africa? Luke, that's a great question. It certainly is a risk. I think it's probably the only risk that South African bonds face, because South African bonds can't really face default because the government can just print more money. But I think the probability of hyperinflation in South Africa is low. And that's generally because demand is, well, first of all, I think we have a very, very strong central bank, which is in fact it's quite a hawkish central bank, which is keeping real rates pretty high. But also, I think it's linked to very low demand and people hoarding cash in South Africa and not investing in South Africa because of the risks. John asks, please elaborate overweight US value. So John, just to say that although we do hold US exposure, even though we underweight the US makes up 60% of the benchmark. We're probably sitting at about 55%, but we do hold some of that in US value. So we underweight S&P 500 and we overweight US value stocks, which means you overweight US industrial stocks, overweight US bank stocks, for example, and mostly underweight US large cap tech. Private sector will generate their own electricity. That is a reality. What are the implications for Eskom income and SA economy when this happens? So, good question. I'm not sure if I mentioned it earlier, but I think this is incredibly good for the South African economy. I think that we're going to see a huge increase in investment. As I said, the mining sector are going to invest they're going to generate 10 gigawatts. That's going to require a huge investment. So I think partial deregulation of electricity is going to be huge investment, and that's very good for the South African economy. That will lead to job growth, which is also very good for the South African economy. So I think that things, and obviously it will help reduce load shedding, which is very good for the South African economy. So I think that money is going to be spent, jobs are going to be created, and things are going to look quite good, although in the end it'll happen with a lag. Eskom is going to be the big loser because they will face reduced demand. They're also going to have reduced supply, which means they're going to be face increased rates. I don't think they're going to be allowed to go bankrupt, so you'll probably find that it'll just be increased subsidies like we saw for years on SAA. SAA for years managed to keep going because the government just bailed it out. So they couldn't compete on a level playing field. They ran a loss, and that's probably what's going to happen with Eskom. They'll keep going, won't default, it'll just run at a loss. Anything could happen. Martin asks, do you think Sygnia will ever have offshore funds we can invest directly in as opposed to feeder funds? Martin, that is my favorite question of the day. We already have $3 based funds that you can invest in. So we have a global income fund, which is invest in short-dated instruments, fixed income instruments, 1 to 2 years, so slightly better returns than cash. And it's currently yielding 4%. Very little risk. It's nicely diversified. It's got about 70% in dollar cash and 30% in euros. So you're getting a 4% yield in dollars, very little risk. That's a wonderful fund. We've also got the Fourth Industrial Revolution Fund available in dollars. And we've got our health innovation fund in dollars as well. So if you've got money offshore and you're looking for either of those three funds, either a place to hide in terms of earning 4% cash, or if you want exposure to my favorite long-term theme, which is healthcare, health innovation, which I think will outpace GDP growth by leaps and bounds over the next decade. Or if you like a fourth industrial revolution, which yes has some short-term headwinds because of high interest rates in the US, but again, those companies are going to see huge market share growth over the next decade. If you like any of those three funds, they're all available in dollars. Very low cost funds as well compared to other offshore funds. They are on the Prescient Manco They are available through a number of platforms. I can't remember the platforms offhand. Unfortunately, not currently on our platform. We're still working on that. But if you email admin@sygnia.co.za, they will let you know which platforms you can find those funds on. Good question from Anonymous, asking for the difference between a preservation fund and a retirement annuity. Honestly, I should be able to answer that as an actuary, but I'm not up to date with the latest regulations that do keep changing. The preservation fund is something that you'll keep with you when you change employers. A retirement annuity either can be linked to an employer, or you can have a retirement annuity as a standalone individual, not linked to your employment. They tend to be separate pools. So you'll have a ring-fenced preservation fund, you'll have a ring-fenced retirement annuity linked to your employer, and you may have your own or a couple of retirement annuities which are just linked to yourself. They all have relatively the same legislation that governs them. That we are trying to simplify that whole process, and so there is actually very little difference in terms of how that can be invested and how that is accessible when you do hit the age of retirement. So not too much different, besides the fact you have to keep them in different pools just from legacy reasons. Martin asked, for someone who's considering immigrating, what funds would you suggest you invest in now? Well, I suppose it would depend where you're immigrating to. Again, it's all about your liabilities. If you're going to go to New Zealand, you might want to invest in the New Zealand stock market. If you're investing in immigrating to Canada, you might want to invest in the Canadian stock market, or likewise for Europe. But I suppose you could have a nice global balance of assets, and invest in, for example, the Sygnia equity fund of fund, or the Sygnia global balanced fund of funds, both of which are pure offshore funds. But again, I would do that in tranches, because I do think the rand faces more. I think the rand is pricing a lot more risk than exists right now, and I think as inflation rolls over in the US, the rand will see some strengthening over the next year. So take money offshore in tranches. Richard asks what sectors in South Africa we take views on. Richard, we don't actually take views on SA sectors. We only invest in the SWIX as an SA equity exposure, or if we want value exposure, we invest in the Divi fund. But those are two active two SA views. Or we've got the South African Equity Unit Trust, Sygnia SA Equity Unit Trust, which has exposure to our active SA managers, and they do take sector exposures. So if you want the best sector exposures of 91 and Coronation and Lorium and Visio, you invest in that unit trust, you'll get their best view. Oliver asks if the crypto market will bounce back and whether it'll become a legitimate asset class. Oliver, I don't think it's going to go away. I just think that in the next few years, people are still digesting what happened and accepting that there's a lot more credit risk than they thought was in the past. And so it might take a while before it becomes a legitimate asset class. And certainly, I think there is a move to this decentralized exchanges, and I think that will reduce a lot of the credit risk. And I think once decentralized exchanges are more accepted, we could see a bounce back. But I think for now it's going to take some time. Alan says, "Is Magda back?" Yes, Magda is back. It's lovely to have her back. Sean says, answer for RA versus preservation funds. RA you can contribute to, preservation funds you can't. So thank you, Sean, for pointing it out. Yes, RAs you can contribute to. Preservation funds are from moving from another company, and that effectively comes closed and ring-fenced. You can no longer allocate money to a preservation fund. Shard asks for the Sygnia offshore funds. If you have dollars offshore, do you have to if you have dollars offshore, do you have to repatriate to SA first? No, no, no. So the Sygnia offshore funds are dollar funds. So if you've got rands, you have to take the rands offshore. If you've got dollars sitting there, you can invest the dollars straight into those funds. A great question from Anonymous, who says, for younger investors, say 30 years to retirement, sure, I wish I had 30 years to retirement. Is it good to continue remaining aggressively invested, max equity and max offshore? Reality is that these investors probably won't even recall what happened in 2020, 2023 when they look back in their investment, and the timing of the market isn't easy. Certainly, I think that if you are a young investor, if you don't want to, I certainly think, and I've got all my retirement fund exposure is through Skeleton Balance 70, which I still think is the best view. It's got 70% equities, which is close to the maximum of 75. It's got 35% offshore, which is close to the maximum of 45. And it's very well blended. But if you want to do it yourself, and if you're young, and so if 30 years to retirement means what, 25, yes, certainly you can put maximum equity, maximum offshore, and invest for the long term. I think that is a perfectly reasonable investment. If you've got a long-term time horizon, you can certainly accept the volatility and look for maximum returns. That will happen. But again, as always, as I've said, if you're going to do it that way, stagger your investment, because there is volatility in the rand. There is volatility in markets. The markets could pull back. Equities could pull back in the next 6 months. The rand could strengthen in the next 6 months. So you don't want to go maximum offshore, maximum equity all today. Stagger your investments. And that's sorry, there's a few more questions coming in. Clement asks, I have invested in the Sygnia S&P 500 ETF. I'm thinking of investing in the MSCI World ETF. However, I'm worried about duplication since the MSCI World holds about 65% in the US. Would it be better to invest in MSCI emerging markets instead of MSCI World? Clement, that is a brilliant question. We actually were thinking of launching an MSCI World ex-US for exactly that answer, but we haven't launched it just yet. But so I think the best way to diversify is, or either you could switch your US exposure into MSCI World, and then you wouldn't have to worry about duplication, or you can build the rest of the world exposure by investing into our other building blocks. So invest new cash flows into the Stocks 50, the Sygnia Stocks 50 ETF, which gives you exposure to Europe. You can invest into the Sygnia Japan ETF, which gives you exposure to Japan. You can invest into the Sygnia MSCI Emerging Markets ETF, and that gives you exposure to EM. So if you split it across Europe, Japan, and EM, in those three ETFs, you'll basically create your own MSCI all-country index, and you can be well diversified that way through new cash flows. As I've said, the Debbie funds did struggle in February because of resources. Resources were down about 12% in February, which pulled the South African market down to 3%. South African market was amongst the worst in the world in February, driven primarily by resources, and that was on a slower outlook in China in particular. LS asked if we'll consider bringing out a retirement annuity with max 45% offshore. Right now, not. We are also thinking about it. It is in our plan. And for the moment, we're sticking with our best investment view, which is 35 offshore. And we have all the building blocks available on our platform for you to build it up to 45 if you wish. That may change. We may launch a separate fund. Remember, we do have the Skeleton global range on our platform, which is effectively 100% offshore, a version of our domestic balance fund. So it's 100% offshore with exposure to our equity building block with all our themes, and global cash and our global alternatives. So if you want to get to 45, you can blend either the building blocks, or you can just blend the skeleton global balance 70, my favorite, with this, sorry, the skeleton balance 70, which is my favorite, with the skeleton global 70. So look out for the skeleton global range. So I know we don't do anyone any favors with we've got the skeleton range, we've got the skeleton balanced range, we've got the skeleton global range. And the skeleton global is on the life license, and it's 100% offshore brands. Skeleton is on the life license, and that's the domestic version, and same as the skeleton balance, which is the unit trust range. So just be wary of the 3 different ranges there. But yeah, unfortunately, right now you'd have to blend it yourself, and you can blend it by investing in skeleton global and the other ranges that exist. Or pick your building blocks, top up with 4th IR, or if you want more equity, more non-equity, but you want higher growth, invest in the Sygnia Global Property ETF, and then you can get about the 75% Reg 28 limits for real assets. So there are building blocks that you can use to achieve higher growth. Sean asks also a great question. If the US recovery drags on due to a lagging higher inflation environment, which is our base case, why would you expect EM to outperform, and which is driven by DM sentiment? Sean, you've hit the nail on the head with this question. We've already seen it happen. So the US rates, so 2022, we saw US rates rally very strongly, and they diverged. Well, they were much. US rates went up, inflation went up higher than European rates and other Japanese rates and the emerging markets, and inflation also diverged. And as a result, the dollar strengthened hugely, and we had a major risk off. Over the last 3 months, not 3 months, let's say over the last 6 weeks, I think, as in US inflation has surprised to the upside, US rates and US bond yields have gone up, but to a lesser degree. But what hasn't happened is the dollar hasn't strengthened. It's strengthened slightly, but as they were correlated 1-for-1 over the last 18 months. And over the last 6 weeks, we've seen big divergence where higher inflation has been priced into the US, but the dollar is not strengthening as much. And I think the big reason is because last year we had US rates strengthening while US growth was stronger than the rest of the world. They had, as I said, perfect storm in the US. This year, yes, the US is facing high inflation, but we've got we're unwinding that perfect storm. And we've got China bouncing back its growth, Europe bouncing back its growth, emerging markets bouncing back with their growth. And so the US growth is slowing compared to the rest of the world growth, and that's neutralizing the dollar. So the dollar isn't strengthening as much as interest rate differentials and inflation differentials would suggest, which would certainly strangle the rest of the world's growth. But because the rest of the world's growth it's a bit of a circular reference, but because of energy prices being lower in Europe, and because of lockdowns being reversed in China, we've got this bounce back in growth, which is supporting rest of the world growth despite higher rates in the US, which means the dollar isn't strengthening, which means that we aren't seeing a chokehold on growth, which means that despite the US slowing inflation environment picking up, because US growth is slowing relative to the rest of the world, things are okay. And that's part of, I suppose, that's our big thesis. The big thesis is the Great Rebalancing. The big thesis is that goods inflation slows, services recovers, the US slows, and the rest of the world growth recovers, and that all allows things to muddle through this year without facing a massive recession. And certainly markets have now agreed with that view. It's become, when we started talking about this view, we went on the road in October last year, and we were very bullish, cautiously optimistic, and telling everybody while the markets were very bearish, and we were very overweight risk and underweight the US. And that worked really well for us over the last 3 months. Now, markets mostly priced it in, and so it's not as clear-cut what to do going forward, but I do think that that's still the base case, muddling through with some more surprises to the upside from Europe, some more surprises to the upside from China and emerging markets, and even Japan, while the US is neutral to down. And the noonday gun has just gone. So I'm going to sign off. Thank you, everybody, for your questions. Thank you for joining. It was lovely to see everybody, lovely to engage. I really appreciate your time. I wish you all the best for March. I hope it's a good month. So far, so good. Yeah, things aren't as bad as they seem. There's certainly good reason that South African equity market can continue to do okay with a recovery in South Africa within time because of partial degradation to the electricity sector, but also because earnings are 70% to 55% offshore on the JSE, which does bring some comfort. Thank you.